Hi all, hope you're doing well. Welcome to our channel India Equity Investing. And today we are going to review the first quarter performance of SH Kelkar. We will start by reviewing the quarterly performance of the company, the key management comments, and the key parameters to track for this company before looking at the financial outlook. In case you would like to learn more about the company, we recommend you to review the last presentation published by us on the company on April 19th. Link is given in the description below. So, as expected, the company delivered good quarterly performance, with the company reporting 445 crores of revenue during the quarter at 7% YY growth. This growth was basically driven by the fragrance business, which grew by 10.8% during the quarter on YY basis and contributes around 85% to the total revenue. The decline in the raw material prices by 440 basis points resulted in the gross profit margin of 44%. The gain in the raw material price decline was partially offset by higher employee cost that resulted in net EBITDA margin expansion by 260 basis points. Overall, the company achieved PAT of rupees 28 crores during the quarter at 6.2% PAT margin. Here we look at the quarterly performance of the company over the past 13 quarters. So the Q1 performance has already been summarized on the earlier slide. I think one key point I like to bring to your notice over here is that if we carefully see the company's revenue growth from third quarter of FY21 to first quarter of FY24, we see the incremental revenue that has been generated by the company is to the tune of 70 odd crores. Now, this has resulted in the gross profit increase in absolute terms of around 32 odd crores. But the resulted EBITDA increase is only 3.7 odd crores. So going from 67 crores to 70 odd crores. So the operational costs have basically offset the entire revenue growth that could have resulted in the higher profits. So, and at the EBITDA level, it's virtually flat, rather marginally negative, right? So the theme here is that the EBITDA margins have gone down, but now the reason why we believe the company is likely to generate a higher EBITDA or profitability for higher growth is because we believe the margins are likely to remain stable going forward. So with stable margins coming in, we expect the overall EBITDA numbers to increase. And the one hit that the company is now going to take is on the higher interest cost. So the interest expense of the company has reached 10 odd crores for the quarter, which is around 20 odd percent of the EBIT generated by the company. And while the debt profile of the company remains serviceable today at current levels, it will have to be actively managed by the company going forward. Now we will look at the key comments made by the management after the Q1 results. So first we'll talk about the European business. So the European business did well during the quarter, while on YY basis the revenue growth remained flat at around 2%. It did generate a healthy EBITDA margin of around 24% as compared to 14% in Q1 of last year. And the company expects the margins to remain stable going forward. Now, this European facility is already operating at 85% odd capacity utilization. So, greater revenue growth over here cannot be expected. And we overall expect the business to remain stable going forward. On the raw material front, the raw material prices have come down and the company expects the costs to remain stable going forward. Now, what the raw material price decline is going to result in is that, the company can now focus more on business growth and reach out to new clients, which the company did not pursue actively in the previous few quarters because the company was in any case facing challenges in meeting the existing requirements of the company of its clients, given the raw material scarcity as well as higher prices. The global ingredients business of the company had been facing quite a bit of pressure over the past few quarters. And, the backward integration that the company had initiated, in India for this business is on track. and the raw material supplies are expected to commence from domestic suppliers in Q4 of this year. And this will help the company to become one of the lowest cost producer for some of the global ingredients. um, you know and and the company expects this business to turn around by the end of this financial year. Overall, this business can generate a EBITDA margin of around 10%. And and during this quarter, the company generated a 14 crore revenue from global ingredient business with an operating loss of around 3 crores. In the debt front, the net debt of the company currently stands at rupees 513 odd crores. And the company expects the operational debt to come down due to better cash flow generation in the quarters going forward. But at the same time, the non-operational cash requirement of the company is going to be high over the next few quarters. That is because there's a investment in Indonesia plant that is expected to be in the range of $5 odd million, which is likely to take place. And then second tranche of the payment for Holland Aromatics acquisitions, which we believe would be anywhere between 30 to 40 crores, has to take place. A dividend payout is also expected to happen, and upgradation of flavors facilities also expected to attract new clients. And these all factors combined with the focus on growth will result in limited debt repayment during FY24. So the debt levels are expected to remain higher, but the company has indicated that on a working capital days basis or the debt to equity ratio basis, it is likely to maintain reasonable levels going forward. So here we look at the fragrance business performance during the quarter, and this segment generated 380 crores of revenue during this quarter, which included a 6% volume growth and 14 odd percent operating profit margin. And going forward, we expect this segment to grow at an annualized growth rate of around 9 to 10%. Now, if we see the previous 2 or 3 quarters, say Q2 and Q3 of FY23, the operating profit margin of this segment took a hit. That was because of the higher raw material costs and consolidation of distribution network that took place in the Middle East during second and the third quarter of FY23. Now, since raw material prices have started to go down and the distribution network consolidation has taken place, the operating profit margins have started to improve. And overall, if we look at the demand scenario for the fragrance business, the company believes the demand remains robust both in domestic as well as global markets, and the company is going to focus on reaching out to new clients in this business segment going forward. The flavor business degrew during the quarter, and was at 49 crores for Q1, contributing around 11% to the total revenue. And the company believes that we can't look at this business on a sequential basis due to seasonality in the business. And the business is still in the growing phase. Overall, the company is looking to grow this segment at anywhere between 12 to 14% CAGR over the next few years. Now, in terms of the composition of the business, QSR currently contributes around 25% to the segment's revenue. And QSR is basically a high volume and a low margin business done by the company. So what the company is looking to do is, besides QSR, now they are looking to get into new categories like baby care and pharmaceuticals. Now, for that purposes, the company is looking to target large MNCs in these categories. And in order to attract them, the company will have to upgrade its manufacturing setup that it has today for the flavor business. And this will likely involve a investment of around 7 to 8 crores. But overall prospects for this business look bright going forward. Now, where the company stands today, I believe there are three key parameters on which we will look at this business for at least next few quarters. One is the revenue growth. Now, the revenue growth for the company, based on what the company has achieved over the past many years, excluding the acquisition, and what the company has guided for, we believe the company's long-term revenue growth is likely to be in the range of 10 odd percent. And it's not great, but we believe this is a number which is attainable in the next few years to come. And on the margin front, we believe that, until unless the raw material prices really spiral out, 15% EBITDA margins are sustainable, and domestic sourcing for global ingredients business and reduction in the contracting business will aid in some margin improvement and creating buffer for that as well. And thirdly, I believe debt is the key point to look at. We believe the near term debt will increase, but the company will generate enough free cash flow to repay debt, and the company will have to keep it at a reasonable level. So until as the revenue growth falters or the margin profile takes a hit, we believe the company's prospects for an investor look reasonably favorable as of now. The next two slides basically summarize the key acquisitions done by the company over the past few years. We have discussed these acquisitions in detail in our previous presentations, so I would not do the same as of now. Now let us quickly look at the profit and loss statement of the company and the kind of earning estimate that we are projecting. So for this year, we do expect the company to achieve revenue in the range of 1,870 odd crores with a you know uh, consolidated gross profit margin of around 42% and an EBITDA of around 14.8%. Now, this is slightly lower than what the company has projected, but I think we are comfortable with that. And the results would have been fantastic, but for the interest expense hit that is coming in. But still, we expect the company to close to double its earnings at the PAT level during FY24 as compared to FY23, with the estimated EPS to be anywhere between 8.5 to 8.6 for FY24 compared to 4.55 for FY23. And so, keeping FY23 in mind, we expect the company to attain FY26 EPS of around 12.8 rupees, which is based on the premise of around 10% revenue growth and EBITDA margin expansion by around 400 bips over the next 2 financial years. So I think that's kind of a estimates with which we are going in, and let's see further what kind of ROI it will translate into. On the balance sheet front, we have not, modeled any significant change. We expect the key balance sheet ratios to largely remain stable, and some cash generation to take place, and some debt reduction to take place at the same time by the company. So here we see the net working capital to remain in the range of 90 odd days, and asset turns to largely remain stable at around 0.9 to 1x, and ROEs to increase going forward the same time with some reduction in debt taking place. Overall, we expect the company to generate a net free cash of around 400 odd crores from operations after taking care of the capex and related opex, but before debt repayment. So as of today, the company is trading at 22.4 times its trailing 12-month earnings, and with EBITDA margin profile in the range of 15% and revenue growth of around 10%, we expect the company to achieve an EPS of around 12.8 rupees by FY26. And based on historical as well as competitor valuations, we do expect the company to trade in the range of 24 to 25 times its trailing earnings. And assuming a 22.5 times P multiple in our exit year, which is at end of FY26, we do expect the company to generate an IRR in the range of 33 odd percent. And in case the company is able to show some revenue growth with marginal increase in margins beyond what we are already expecting, the company can easily trade at much higher valuations as well. But as of now, we don't have a lot of confidence in the company trading at significantly higher multiples than what we have assumed as of now. Here we look at the trailing 12 months P multiple chart of the company since its listing. And in the initial days, it used to trade at rich multiples. And during this time, the company was generating around 10% odd annualized revenue growth with 15 odd percent EBITDA margins. While we have assumed the same kind of numbers for the company going forward, our exit multiple assumptions have come down, and we are expecting that to be anywhere between 25 to 22 times going forward. So, in case any correction in the company's share price takes place in the coming weeks, then we may look at increasing our position in the company. And with this, we end our quarterly update for SH Kelkar. And I hope you found it to be informative. And we look forward to sharing more such presentations with you going forward. Thank you for your time.